name is Harley Gordon, an attorney for over 25 years and a founding member of the National Academy of Elder Law Attorneys. I've spoken extensively to financial planners and companies including Merrill Lynch, UBS, Raymond James, Edward Jones, and Ameriprise about the serious consequences not having a plan for long-term care will have on the well-thought-out retirement, tax, and estate plan for the very wealthy. Any affluent individual who has had to pay for care will tell you how devastating that decision was to their best thought out tax, retirement, and estate plan. Yet that's the same person who told his insurance professional prior to the event that long-term care insurance was a waste of money. An opinion, by the way, seconded by financial and professional advisors. And therein lies the biggest challenge to insurance professionals trying to sell long-term care insurance to the wealthy. A deep-seated belief, often supported by their advisors, that the product, unlike life and disability insurance, should not be part of an insurance portfolio. Now, challenges present big opportunities. The potential for generating income, serious income, from the sale of long-term care insurance is substantial because the market is untapped and the premium dollars are much above average. And where do you find this market? It's right in your Rolodex or database. All that's missing is a selling philosophy that sets out compelling reasons why the wealthy and their financial advisors have no choice but to purchase long-term care insurance, and a system that will quantify that decision. Now, I've taken my 25 years of experience in educating insurance professionals on how to sell to the wealthy and teamed up with Phil Davis. Phil is a 35-year insurance veteran, a life member of the $1 Million Roundtable, and a 17-year qualifier for the prestigious Top of the Table. Now, his corporate clients read like a Fortune 500 who's who. Now, working together, we've created the CLTC-WealthSecure System. Now, our system is consultative in nature. It starts with your client acknowledging that long-term care costs are a threat to his or her financial security. Then it compares the two funding sources, self-insuring the risk versus transferring that risk to an insurance company. At this point, the client and his or her advisor are left to make their own decisions. Now, there are no threats of insolvency or appeals to emotions, just simple, impossible to ignore facts. In short, CLTC-WealthSecure can expand your business by cross-selling existing clients, attract new clients by positioning yourself as an authority and working with the wealthy, and of course solidify existing client relationships. Take a moment to listen to Phil Davis. He'll show you how the system can work for you.
We put together CLTC-WealthSecure based on years of successfully selling life and disability insurance to the affluent, and equally important, to their corporations and partnerships. WealthSecure will help you overcome the three debilitating objections that come up when we are trying to sell to the affluent. 1, if I buy the insurance and never need care, I will have wasted all of my premiums. 2, if I need care, I have more than enough money to pay for it. I'll just self-insure. And 3, my advisors tell me I don't need care. They tell me to self-insure. WealthSecure will give you the confidence and the competence to overcome these objections. Now, let's take a look at how this dynamic new system will help you increase your revenues, attract new customers, and strengthen the relationships with your existing customer base.
Keep watching for a dynamic demonstration. Learn how to get your clients to acknowledge there is a long-term care threat without mentioning long-term care insurance. The CLTC WealthSecure System is comprised of 2 software programs, the LTC Impact Program and the LTC Funding Program. Now let's take a look at the LTC Impact Program, a revolutionary tool that eliminates the #1 mistake most long-term care insurance agents make, selling solutions before getting their prospects to acknowledge they have a problem. When you use the LTC Impact Program, your prospects will ask you to show them a long-term care insurance solution, a complete reversal of the typical sales process. Also, as you go through the program, notice that you will never mention long-term care insurance unless your prospect asks you to do so. After logging into the licensee-only website, select the LTC Impact program. Enter the client's name to create a personalized analysis for them. You and your client are provided the basic facts of what she needs to know about long-term health care. On the first page, you present your consultative objectives. Then you talk about what long-term health care is all about. Review what care can cost. Point out that care costs are not deductible and that they are paid with after-tax dollars. You point out that a real but unrecognized cost of care is the loss of investment earnings. In addition, when you add the tax surcharge, the total cost of care can double. Point out that 40 out of 100 people over age 65 are going to have a serious long-term health care problem. And then say to your client there are two ways to fund the costs of long-term health care: self-insurance or insurance. Click here to go to the calculators. Now, let's use the software with a real client scenario to see the impact on income if care was needed today. Your client earns $200,000 a year. She has a disability insurance policy that will pay her $100,000 of tax-free benefits if she is disabled. She has $5,000 of interest and dividend income, which is considered other income. The annual cost of a private room in a nursing home for your client's state is $120,000. Lastly, she has $400,000 in cash and cash equivalents. Now your client has a stroke, can't work, and needs constant care because she's partially paralyzed on her left side. Hit Calculate, and you're able to instantaneously show your client the direct impact long-term health care costs will have on her income if care was needed today. You move the cursor over this bar graph, and you see that she has about $153,000 of spendable income after taxes. After she has to stop working, her income drops to about $104,000, a reduction of $48,000. And the client's cost of long-term health care is $120,000. In order to bring her back to about $153,000 of pre-disability income to accommodate the family's standard of living, she will need about $168,000, the sum of her income shortage and the cost of long-term health care. This is just the beginning of the story, but at this point, you and your client are engaged in a fact-finding consultative relationship. To further understand the financial consequences, click here. Your client will have to liquidate $168,737 of her cash reserves, and in less than 2.5 years, all of her cash will be gone. At that point, if she still needs care, she will have to start liquidating investment and retirement accounts with the potential of severe tax penalties. Now that we've looked at the dramatic impact of care costs if they occurred today, let's take a longer view of your client's entire asset portfolio by clicking the Asset Impact Calculator. Your client is a law firm partner, age 55, who has $1 million in retirement plan assets, presumably in her profit-sharing plan. She contributes $40,000 a year to the plan and may have another source of income, such as dividends or real estate, of $25,000. Her goal is to retire at age 65 and, due to the efforts of her advisors, yields 6% on her portfolio. A sale of assets will cause a tax of 35%. The annual cost of care in her state is $120,000 per year. And you assume that she has an extended care event at age 75 that lasts for 6 years, plus the annual cost of care is going up 4% a year. You're also going to model insurance funding versus self-insurance, so click Yes, and the software will auto-compute some insurance amounts for you, or you can enter specific data. You can assume she's in a 35% tax bracket. She is qualified for a New York State tax credit of 20%. And her federal tax deductions on the eligible premium portion of her insurance premium are increasing at 3% a year. Now hit the Calculate button to find that at age 75, her retirement assets total $2,349,000, but after 6 years, her entire $2,349,000 retirement portfolio has been wiped out by the costs of care. Your client asks how this can be, as this is always a huge revelation to them. This creates quite a conversation and allows you to show them where the money went. Click here for a detailed report. You see that her $1 million of retirement assets plus her $40,000 annual retirement contribution invested at 6% has grown to $2,349,713 at age 65. Her income at 6% on that is $140,983, plus her income from Social Security, less her estimated tax of about $41,000, leaves her with $124,845 of net interest income. However, 10 years later at age 75, her long-term health care begins, and her $120,000 of 2010 nursing home costs have inflated to almost $263,000 by age 75. And to pay that cost from her profit-sharing plan, she would have to take a $404,515 distribution because it is taxable. And 6 years later, at age 80, her family's entire retirement portfolio has been wiped out. At this point, your client is actively engaged. It's a good time to bring the conversation back to your client's present position, self-insuring the risk. You now compare the advantages and disadvantages of the two methods of funding long-term health care costs, self-insurance versus transferring the risk to an insurance company. This page reviews the insurance strategy in detail. It shows how tax subsidies can discount the premium cost and shows the amount of insurance benefits that would be available if care was needed for 1 year and 6 years. Additionally, it also displays the premium refund at death if care is never needed, both tax-free and taxable. Next is the self-insurance strategy page, which shows the amount of money Jane could have in the bank to pay care costs if she invested the premiums instead. Now, since no one believes they will ever need long-term health care, this page shows Jane what happens if she bought insurance but died in 20 years without having received any benefits. It compares the premium refund amount with the amount the client could have in her bank account if she invested the premiums instead. The result for Jane's sample is a $16,905 loss. But what happens if long-term health care is needed? If care is needed, this page shows the client the potential cost of long-term health care today, 10 years from now, and 20 years from now. It then displays the cost to the family if she self-insures the risk and the cost to the family if she transfers the risk to an insurance company. Overall, when considering the purchase of long-term care insurance, you're guaranteed to make a mistake. You purchase the insurance and never need care, or you don't purchase the insurance and you do need care. Let's see how that stacks up. The 20-year summary page summarizes each funding option. If Jane purchased the insurance and didn't need care, we know she made a $16,905 mistake, the money she could have had in the bank less the after-tax insurance premium to her family. If she needed care and didn't buy insurance, she would have made a $1,565,887 mistake, the total cost of care less the amount in her self-insurance bank account. However, if she bought insurance, the cost to her family would only be $186,447. Therefore, the net disadvantage to her family of self-insuring would be $1,379,440. Now you can ask the client, which mistake would you rather make? This is a completely consultative approach. The LTC Impact Program allows you to have a serious conversation about the costs of extended health care, and it allows your client to make their own decision. Once they recognize that there is a threat and which funding option is more viable, they will ask you to discuss an insurance solution, a complete reversal of the typical sales process. The LTC Impact Program certainly presents a compelling case for the purchase of long-term care insurance, but your attorney-client or her financial consultants may demand to see where these numbers came from, and that's where our LTC funding program comes into play. This sophisticated program creates many report variations depending on your client's tax status, and you have a dynamic report to present to your client that includes the financial data to back up the numbers presented in the Impact Program. Click on the video titled LTC Funding Program to see how it works. Thank you for taking the time to learn about the LTC Impact Program. Please visit WealthSecure.com and click on our products page for more details about the CLTC-WealthSecure System. We are excited to help you make a substantial amount of money. Welcome to the team.